When traders transition to high-velocity futures like the Nasdaq or the S&P 500, they usually import a basic risk management habit, the flat, static stop-loss. They pick a hard number, say 15 points, and hard-code that boundary into their execution platform. The logic is straightforward. Cap the dollar loss at a fixed amount per trade, regardless of the active market conditions. During the low-liquidity overnight sessions, the market barely breathes. A 15-point perimeter in that environment is wide enough to absorb minor price fluctuations without prematurely ejecting the trader from the position. Apply that exact 15-point parameter at the New York Open, and the geometry breaks. A single 1-minute candle effortlessly crushes that fixed boundary. The execution is run over by standard market breathing before the price rapidly reverses into profit territory. A static defense cannot survive a dynamic environment. Enforcing an unmoving parameter on an asset that constantly expands and contracts guarantees the mathematical collapse of a trading system's edge. To execute safely in these environments, the structural defense must breathe with the asset. The boundary parameters must automatically widen and contract in direct proportion to real-time volatility, completely free of manual adjustment. Building this dynamic architecture requires 3 integrated mathematical layers: multi-timeframe volatility anchoring, a precise slippage tax buffer, and dynamic target projection. When these 3 mechanisms are locked together in a unified system, a trader moves past retail guesswork and operates an institutional-grade engine designed entirely for capital preservation. The first point of structural failure usually occurs in timeframe selection. Traders commonly calculate their average true range, their ATR, using the exact same 1-minute chart they use to trigger their entry. At the micro timeframe level, price action is heavily dictated by high-frequency algorithms executing liquidity sweeps. The resulting volatility measurement is entirely erratic. The solution is to strictly decouple the entry trigger from the risk calculation through multi-timeframe volatility anchoring. While the entry execution remains on the 1-minute or 5-minute chart for precision timing, the risk engine extracts the ATR calculation strictly from the 15-minute or 30-minute macro charts. This is necessary because the 15-minute timeframe filters out the localized noise of algorithmic sweeps, isolating the true structural breathing pattern of the daily trend. This chart demonstrates the risk. Apply a 1-minute ATR to a 1-minute chart, and the boundary is shattered by localized spikes. But project the 15-minute ATR onto that same microchart, and a much wider structural envelope perfectly wraps the exact same price action. The stop loss is now anchored in a higher timeframe safety zone. High-frequency algorithms can aggressively whip the 1-minute candles, but they lack the range to reach a stop structured on a 15-minute metric. Precise execution timing provides zero mechanical advantage if the protective boundary shielding it is calibrated to localized noise. Yet, even with a macro-anchored volatility boundary, a structural vulnerability remains strictly within the physical mechanics of trade execution. When the market experiences a sudden influx of volume or a rapid price flush, broker liquidity thins out. In these fractions of a second, the bid-ask spread forcefully expands. Zooming in on the lower boundary here, we see the actual traded price can hold firmly above the structural coordinate, but an expanding spread zone will push downward, cross the boundary, and trigger a forced exit. Highly accurate mathematical setups routinely bleed capital through this mechanical gap between market price and broker spread. Closing this gap requires hard coding a physical padding layer, a slippage tax, directly into the risk algorithm. For the NQ, the engine adds an exact 2-point barrier below that calculation. This serves as an execution bumper. It absorbs the momentary spread widening, guaranteeing the position is only liquidated if the market's true structure breaks, rather than reacting to a broker's temporary liquidity vacuum. True capital preservation dictates that you measure and defend against your broker's execution mechanics, just as rigorously as the asset's physical price action. The final layer corrects the most common statistical error in dynamic risk, adjusting the stop loss for volatility while leaving the profit target static. If market volatility increases and pushes the stop loss wider to maintain safety, a static target remains fixed in place. A carefully planned 1-to-2 risk-to-reward ratio instantly degrades into a 1-to-1, or worse. To maintain a statistical edge over a large sample size of trades, the law of probability requires that all parameters expand and contract proportionally. As this geometric scale shows, the parameters must be strictly linked. If the algorithm sets the stop-loss boundary at a 1.5 multiple of the ATR, the profit target is hard-coded to project outward to a 3.0 multiple. During a quiet session, the stop-loss is extremely tight and the target sits close. When volatility explodes, the stop-loss widens for safety, and the target simultaneously projects much deeper. This widening point distance creates a final mathematical hurdle. A 20-point stop and a 40-point stop carry vastly different dollar risks if the contract size remains the same. To solve this, the engine applies inverse payload scaling. As the point distance of the stop-loss widens, the engine automatically shrinks the number of contracts executed, ensuring the absolute dollar risk remains identical down to the penny. Linking the target projection and the contract payload directly to the ATR guarantees that the mathematical edge functions identically regardless of whether the market is crawling or sprinting. Operating this effectively requires locking these three dynamic layers into a single automated workflow. This is the view of a completed risk architecture tracking live execution. A digital HUD monitors the high-velocity price action, fully insulated by the calculated boundaries. In milliseconds, the system extracts the macro ATR, projects the dynamic profit target, injects the slippage tax, and calculates the exact scaled contract payload. While retail participants scramble to manually adjust flat parameters and absorb heavy losses during an opening bell spike, this setup remains entirely clinical. The anxiety of market noise is completely bypassed because real-time volatility is already mathematically embedded directly into the system's structural boundaries. True capital preservation is not achieved through willpower or subjective trade-by-trade adjustments. It is a strict mathematical discipline. Stripping away static, rigid parameters and replacing them with dynamically linked variables separates professional execution from mere guessing. Long-term survival requires building an execution architecture that breathes exactly as the market breathes, rather than attempting to enforce a static will upon an ever-changing environment.